Now, our first official session of the afternoon is the Global Economic Outlook, brought to you by Farm Credit Canada. And to walk us through what's happening here in Canada and around the world, I'm pleased to introduce JP Gervais, Vice President and Chief Agricultural Economist with Farm Credit Canada. JP has 20 years experience in analyzing domestic and international agricultural policies and markets, and his insights help guide strategy and monitor risk throughout the corporation. In addition to acting as FCC's spokesperson on economic matters, JP provides commentary on the agriculture industry through videos and the FCC Ag Economics blog. Please go to the website to check out the videos and the blog. JP, I'm going to turn things over to you now.
Hey, well, thanks, Greg. It's really a pleasure. Thanks to CSCA for the invitation. I'm really looking forward to a great session here. I'm going to start by sharing my screen, and I'm hoping that this is going to work real smooth. I'm just going to get to slideshow mode in just a second here. And as soon as this is done, I'll be ready to go. All right, so that should be up and running now. So again, thanks for the invite. Really appreciate doing this virtually, and looking forward to a great session. Couple of things on the agenda for me. And I know you have a lineup of great speakers that are going to dive into the supply and demand dynamics of the different pulses, and so I'm not going to do that. What I want to emphasize, a couple of things. I want to discuss the overall global economic environment that we're in, and just focus on some of the most relevant trends and variables that matter for your profitability in the industry, as well as, just a brief overview of the state of Canadian ag, right? And during this great lockdown that we're continuing to be in, right? And so what are the trends that we're seeing when it comes to cash receipts, land values, and so forth? So a couple of things, I'm going to start very broad, and then I'm going to dive into a bit more specifics around Canadian ag. There are lots of different trends, obviously, and I just want to point out the fact that, yes, I'm going to focus a lot on the COVID-19 pandemic, and at the same time, all the underlying issues in the background. I listened to part of the annual meeting, or the general meeting, and then a focus on transportation issues, whether trade relationships matter. I mean, I'm listing here a few things with a few of these issues with China with regards to the US, or with regards to the deficit and meat proteins that they face. But we have also our own trade challenges and market access issues, right? So all of that are looming in the background, so to speak. Of course, it makes total sense that in the media and everywhere else, we're focusing on the COVID-19 pandemic, but all these other things matter as well. And so when you're trying to highlight a few trends when it comes to profitability, let's remember that there are tons of issues that work in the background. And so aggregating all of this and making a consistent story of what is to be expected in the next few months through the rest of the year, as well as into 2021. That's a tall task. And I'm going to share with you what we're seeing in terms of trends at FCC, and hopefully you can grab some of the information and bits that are relevant to your business and use that as you're planning for the rest of the year, as well as in 2021. So a couple of things here on this particular slide. Sorry, I'm just going to go back here if I can. The one on the left-hand side, the graph on the left-hand side, is really a picture of world economic forecasts by the IMF. Those forecasts are a bit dated, right? So for the world, for example, the first thing that I circled is this blue bar getting all the way down to 4.5, if I remember on top of my head, but larger than 4% decline in world GDP. That's significant. Anytime your world GDP falls underneath 3, GDP growth falls underneath 3, and we were right at that threshold in 2019. You're looking at some serious slowdown in the world economy. So to go into negative territory like this is quite something. And of course, if you look at our own forecast, or the forecast for Canada, at 8.4%, a little bit too pessimistic in my head, and I'll say why in a little bit, but we might not get to minus 8.4, but the bottom line is this is going to be significant when it's all said and done in 2020. But what matters is as well as what's going on for 2021. So what if I focus on the Canadian story, this is the right-hand side, or the chart on the right-hand side that's titled Monthly Canadian GDP Growth. A couple of options, right? The one headline that gathers lots of attention is the 38.7% decline in GDP for the second quarter of this year. So just so that people know, right, we're talking about a variation in GDP from quarter one to quarter two on an annualized basis, right? So that's how usually these numbers are reported, right? So 38.7, that's the pace of the contraction in that second quarter. We don't expect, nobody expects actually, that we're going to get a decline in 2020 of 38.7%. It's just the pace of the contraction. And so you can focus on that, which is quite a negative headline, or do you want to focus on the May, June, and July rebound, right? Because if you were going on a month-to-month basis, you're seeing that in May, GDP went up by 5%. In June, I believe it was 6.7%, if I'm not mistaken. And in July, the expectation, because you still don't have the actual numbers, they're going to come out later, but the expectation is around 3%. So we call this an advanced estimate, right? So there is a rebound, but you have to wonder what it's going to look like for the rest of the year as well as in 2020. So on the world level, why am I convinced that things are not going to be as great for the rest of the year? Well, a lot of it is really, it boils down to COVID-19 and the control or lack thereof that countries have over the virus, right? So the US, a lot has been documented about the US. And if you see, I encourage you to go to the Johns Hopkins University website, where most of the countries that we deal with when it comes to Pole Strait, they're all listed there in terms of the evolution of the disease in the different countries, right? So in case of the US, a lot has been made of the jump in a spike of cases over the summer. And if you look at the most recent data, I think I downloaded the data about, I would say maybe just late Friday last week. You're looking at, that the US is, using a moving average of 7 days. It's looking up to that they're starting to gain control on the spread of the virus after a lot of discussion around this huge spike, that the US experienced in July. Now, if you look at a country like India, I mean, they're not even talking about having flattened or flattening the curve. They're still in that growth. And of course, in terms of cases, everything needs to be put in perspective with regards to the overall size of the country. I get that for sure. But I mean, nobody wants to have a trend that looks like this. So there are a number of challenges for different countries. If you look at China, for example, and the weight that China has on the global economy as well as in ag markets, I mean, things are looking up in terms of rebounding somewhat significantly, especially if you look at other parts of the world. But the big unknown is, how is a country like India going to navigate this crisis? And what kind of economic stress that's going to put on the country, right? And there's a lot of unknowns right now. And frankly, I think, where we're seeing a little bit of a rebound, and I'm going to use the Canadian example as a case study of some sort, when there is a little bit of rebound when it comes to GDP, which is sort of the broad measure of economic well-being that we're using, there's still a lot of questions around, right? So people talk about this, what I call this alphabet of economic recovery, right? If you have a V-type recovery, people will refer to it as a sharp decline, just like I was talking about in Q2, but then a sharp recovery as well. The thing with this is that even if, if you look at the forecast for the recovery in the end of 2020 as well as into 2021, most forecasts would suggest that by the end of 2021, you're not going to get back to where you were at the end of 2019. And I think that's very critical to understand, right? We can have this V-type recovery that people like to point out, but to gain the last few percentage points that would get us back to where we were at the end of 2019, those are the hardest to get to, right? And so because you have, at the outset of the recovery, businesses are reopening, and it's an injection of cash flow for businesses. You can see, with some of the measures that have been taken by the Canadian government in terms of smoothing income fluctuations for some segments of the populations that were more exposed to the virus and the economic slowdown and all of that. That's good. But it's that, that second wave, and I'm not talking about the virus here, but that second wave of economic distress sometimes that comes in. And then once you realize that, some businesses are not going to make it through and so forth. So those last few percentage points when it comes to GDP are going to be the hardest to come by. And so even if we have a V-type recovery, I'm not even sure that we're going to get back to where we were by the end of 2021. So that's going to take some time to resume the path of economic growth that we were in. Of course, what we want to avoid is some sort of W-type recession or recovery where, we are in the middle of the recovery, but then we have to shut down the economy once again. If indeed the virus picks up speed in the overall population. Part of the actions and I did allude to that already, that part of the actions of the Canadian government were to smooth out some of the fluctuations in income and not put people and businesses in the spot where they're looking at some long-term economic damage from the crisis that would spell out an L-type recovery where some of the economic damage that we're seeing in the economy has some sort of permanent nature to it. And that's what really is the purpose of public policy in terms of supporting the economy. Now, if you look at some of the actions on the fiscal side of it, the own estimate of the government in terms of the deficit is at $343 billion for 2021. I think the consensus now is that this is going to get a little bit larger than that. But the bottom line is, if you focus on the light gray line, that this debt to GDP, right? Because it's one thing to carry some debt, but you have to put things in perspective, as in, for example, the ability to repay that debt, and that would be tied to the size of the economy. That we're, bumping up to perhaps, something like, I'm going to try to use the pointer here. I don't know if I can do that successfully. There you go. You're going back, at this level here, you're really at 50% of GDP. I mean, we've been at a higher level, especially in the 90s, where, we had in the 90s financial markets questioning whether or not we were going to be able to get this debt situation under control, and some significant actions were implemented at the time to bring debt under control. And now, with the crisis, I mean, we're seeing this go up. And of course, I think if there's a little bit of good news in all of this, is that the lower interest rates are making the fact that it's easier in some ways for the country to carry that debt, because if you look at the public debt charges, again, as a percent of GDP, you're looking at something that has been declining. As we lower debt, I mean, obviously the debt charge was going down, but as interest rates as well have been going down, you could see that this debt charge has been coming down. And so despite the growth in debt, the debt charge looks to be reasonable in that sense. Talking about interest rates, this is a picture that I like because it not only focuses on what the Bank of Canada rate is at, but also focuses on what are the financial conditions in the marketplace if you're a business looking to borrow some funds. This is not just an ag figure. It comes from the Bank of Canada, so it includes all sectors of the economy. But what this blue line looks at is the average borrowing cost, so long-term, short-term borrowing, fixed rates, variable rates, and so forth, with everything in the same basket, and then come up with an average, right, or some sort of benchmark. And if you look on the far right, at the end of this chart, we're at a level right here, if you see my laser pointer, that's been, in terms of borrowing costs, we're the lowest on record. I only go back to the beginning of 2017, but the bottom line is that the previous low on record was in the early part of the summer 2017. So we're at the lowest point right now. I mean, if you compare it to where we were in the spring of 2017, we're not. I mean, you have to put things in perspective as well, focusing on the axis here, the scale that I'm using. I mean, we're talking about just a few basis points, right? So maybe 0.1, 0.2% top lower than what the previous low on record. But nevertheless, I mean, we're at historic lows when it comes to interest rates. And there's good reason for this, obviously. And that's tied to the Bank of Canada. I did say that I'm not focusing on the Bank of Canada rate. The Bank of Canada controls the short-term rate, which has a direct influence on prime rate, and will have a direct influence on the variable rates that business pay. But it's hard, or harder, I should say, for central banks to control the other interest rates in the economy. And so what they need to rely on are different tools to lower overall borrowing costs. And one of these tools is quantitative easing, right? Something that has been used quite a bit in the US, but it is relatively new for us. And so there's lots of things going on in this, but I'm just going to point out two arrows, right? There's one right over here, and there's a second one over here. The first one points out to the size of the amount of liquidity that the bank has injected, the central bank in Canada has injected in the economy relative to the size of the economy in Canada. And if you compare where we are, which is the light orange type line there, if you compare what the Bank of Canada did or has done since the beginning of the crisis to what other central banks have done, you can see that the Bank of Canada has been really aggressive. Of course, it's never going to have the size of the US Federal Reserve, but if you put things in perspective, you know, relative to the size of the economy, the Bank of Canada has been quite aggressive in trying to push those long-term rates down. And that by buying assets, raising the price of bonds, and with the interest rates being inversely proportional to bond prices, then that push down rates. And I can explain that a little bit later if anybody's interested. That's quite different than what the Bank of Canada has done at the outset of the global financial crisis of 2008, 2009, right? You look at the pattern of what the Bank of Canada has done, it did very little. It has done very little. It did very little during the global financial crisis. So it's quite a reversal to compare to what the bank has done historically. And they've been really aggressive in pushing these rates down now. So what do we expect for the future? I mean, we just got another inflation reading this morning. It's very low at 0.1%, right, year over year. So you're talking about inflation that's almost non-existent. Unemployment is still very high. About 1 million Canadians are still unemployed. It's hard to get a sense that nothing's going to happen in 2020 when it comes to interest rates. I would believe that nothing's going to happen in 2021 when it comes to interest rates. They're going to remain low. So there are great opportunities to lock down some long-term rates, for sure, because those rates, rates across the entire yield curve have been coming down. But the flip side of that is, yes, there's a great opportunity to lock down rates, but then short-term rates are low as well, right? So, so there's flexibility for businesses is the point. I think, there's no one size fits all. And so I think this is something to investigate and look at the financials, look at the strategy going forward and lock in some rates if it makes sense. The final financial variable that I'd like to emphasize is the exchange rate. There's something going on right now that I have to admit I didn't see coming. If you focus on the red lines, that's the value of the Canadian dollar. So if the line's moving up, that means that the Canadian dollar is gaining value. And since really we reached a low of about 68 cents, 60 US cents on the dollar per Canadian dollar, we had a steady climb in the value of the Canadian dollar. And that, I have to admit, is a bit of a puzzle. It feels like the markets are getting ahead of themselves in terms of how solid and how sustainable the rebound is. A lot of it, though, I would say, and that's the reason why I'm putting the blue line there as well, which is the euro. Sorry, it's not properly labeled. The red line is the exchange rate with the US dollar. And the blue line is the exchange rate of the Canadian dollar and the euro. And you see the red line moving up since March or April. And you see that this blue line has been, yes, we lost value against the euro, but it's been pretty flat. So what this basically says is, and that's true for other currencies as well, that for countries that are involved in pulse trade. So if you think of, in pulse production, if you think of the Turkey, India, and so forth, I mean, it's this story is about the weakness in the US dollar. And I would think that as And that's not entirely a bad thing, right? We tend to focus on the fact that, hey, when our dollar goes up, Canadian dollar goes up, it's not such a good thing. And I get that, right? From an export position, it's not necessarily a good thing, but there's a couple of other things that we have to be thinking about as well, right? A weak US dollar, well, that raises the purchasing power of those countries that are importing pulses, for example. So I would say, generally speaking, we're better off with a low Canadian dollar environment. But in this case, I mean, there are some positives in the marketplace, especially for those pulse importing countries. Um, the one thing I'll say is do I expect the weakness in the US dollar to be sustainable? I would say no. I mean, I do think that as we're getting into towards the end of 2020, there's a U.S. election. We'll see if that changes anything. I doubt, right? Sometimes we tend to make a whole lot of noise about elections, and they tend to have very little impact from an economic standpoint. There's a different story for other parts of the country, but from an economic standpoint, I'm not so sure that it makes tons of difference in terms of the economics. But yeah, maybe there's a bit more uncertainty and risk coming into the rest of the year. And I would expect the exchange rate to start going back towards that 75 cents and maybe breaking the floor of 75 and having an exchange rate a little bit lower against the US dollar. I'm a bit surprised by the strength of the Canadian dollar. If you look at the historical relationships, accounting for the different interest rates between the two countries, oil prices, those usual suspects, right? When you try to explain the exchange rate, I would say that the Canadian dollar is a bit overvalued in this case. And so I would expect it to be a little bit lower in 2021. Having said that, I mean, there's no real way to find out exactly by how much, but I do think that right now, we might not be on a sustainable path. I know we're at 76, so right around 76 today. I do think that it's possible that we stay at that level, go up a little bit before the end of the year. But again, as I said, in 2021, I would expect a bit more, go back to a little bit closer to 75 than it is, or than it has been in recent past. From a trade standpoint, pulse exports have been moving well, so I think that's a good news story. Yes, there are some significant market access issues that stand in the way of trade and efficient trade. But by and large, I think it's been a very positives at the outset of the pandemic. If you look at the April, May, and June, July as well, I mean, year over year, or it's showing up as very good performance. And so I think that's one of the positives when it comes to pulses. I mean, of course, and I'm just keeping a track on keeping a look at time now. Just to focus on this, I mean, there's tons of things we could say about consumers. I think the one thing I'm going to emphasize is there's lots of shifts and consumer behavior patterns domestically, and the economics are driving some of these changes, right? Of course, the confinement measures and so forth, they do have an impact, right? Restaurants shutting down and food service shutting down and so forth. Then the question going forward is, what is the economics going to look like for the average Canadian household? Is that more favorable or less favorable to plant-based diets? And the second thing is what about those consumer patterns that we've seen more online, sort of the growth in the food and the groceries versus the food service, how all of that is going to return to some sort of normalcy, and at what level, I think is really the big question mark that we need to monitor going forward. I do think, though, that more focus on basics versus high quality, locally sourced, those things, and then food at home trends are not going to go away. I think we might see a little bit of a return to normal, but I think some of these trends are here to stay. And that does matter for some segments of the business. Okay, so focusing on now on more specific to Canadian ag, I just wanted to show you this table here. I mean, just to highlight, I mean, things that we already know, right? I mean, we have, this 2019 cash receipts numbers. We got the first 6 months in terms of cash receipts for all these different sectors. And then, taking those first 6 months into account, understanding or accounting for what futures markets are telling us, then that results in some estimate of what we can expect for cash receipts. I think the good news story is, if you look at on the far right, this very last column right here of change from last year in 2020 when it comes to cash receipts, you're seeing what the positive that I circled at the top. but you also see some of the supply chains that are financially challenged, and where some of the economic challenges are more significant, right? If you look at red meats is an example where we're seeing some significant challenges. What does it all mean? Well, I think, from a financial standpoint, we need to understand where we were prior to the crisis. And there's lots of financials in these four charts. I think the messages are, one, of course, there were some pressures on liquidity in the industry, right? So those are stats for the province of Saskatchewan. The story would be the same, basically coast to coast. I mean, certainly in the across prairie provinces, but I would argue as well. But you can see that if you look at a current ratio, your interest rate coverage, those are financial ratios that suggest that liquidity pressures are quite significant. When it comes to return on equity, if you focus on the 2019 number here on the far right bottom corner there, that number is pretty low, right? High land values, gains in equity, strong balance sheet from a return on equity standpoint, with pressures on income, on farm income. We're seeing some low returns, historically lower than what the average has been. Another way to look at this is looking at farm cash receipts. I'm picking Saskatchewan just because the mix of ag activities in the province, which is 75% and more of the mix, focusing on grains, oilseeds, and pulses. And after years of flattening out in terms of the gross income, the 2020 forecast on the far right of this chart is showing a bit of growth, which I think is good news, right? Because we had two waves of growth when it comes to cash receipts. And we had 5 years of flat to very slightly declining cash receipts. And now with the numbers I showed you in the table in terms of cash receipts, we're finally projecting a little bit of growth. From a net income standpoint, it matters as well, because we had, 4 consecutive years, in this case, of declining net cash income. And that's mostly the result of flat gross revenues and rising expenses at the farm level. So that's those pressures that I was talking about on liquidity that were absolutely real. Thing is, though, that we're faced with these pressures starting from a very, very strong position. If you look at the 2015 number, where we reached a record high net cash income over $5 billion, and that was in 2015. Bottom line is that there were some significant pressures. And if in 2020 we're able to grow gross income the way that I was showing up on the screen, if these forecasts come to materialize, and with lower farm input prices in some cases, some other farm inputs have actually gone up slightly in prices during the pandemic, but there's been some inputs, if you just think of interest rates, energy, and so forth, that have been coming down. I think this is going to help as well alleviate some of the pressures on costs that we had seen in recent years. Just talking about the 2020 crop, those numbers, like I said, not going to focus on the specific, supply and demand, but, there's just lots of different numbers. You see acreage for lentils going up 12% in 2020, slight decline in pea acreage, but still higher than the 5-year average. But if you account for those estimates of seeded acres, take into account some estimates for yield, this is what production looks like, right? So even though for peas, you're looking at a little bit of a decline in seeded acres overall in Canada, well, the projection is for a slight increase in production. Lentils are moving up as well. Yes, wheat, could be a little bit lower than last year, but overall, there's going to be a significant crop. And I think things are looking positive. There's some pockets, areas where there's been some challenges, but overall, I would say that these numbers, we're looking at some strong production for 2020, which explains some of the positive forecasts that I was putting up on the screen. I'm going to end with just another 5 minutes here. This is it flashes up like a warning on my screen, so that may be a little bit too strong of a message, eh? But two things, two sort of principles that I use all the time, right? Supply and demand rule. And when you feel that, something's wrong with supply and demand, well, I tell myself, markets are never wrong for a long time. They can be wrong for some time, but, never for a long time. And you're more likely to be wrong than the markets when it comes to, make an assessment about where prices are going and where they should be going and those type of things, right? So what we do is when we make forecasts about prices, because as a lending institution, we need to make some assumptions about how, what price trends are going to look like and so forth. We really rely on what markets are telling us, right? Rely on futures, rely on the history as well between the different crops if there's no futures markets. And that's what we tend to do. So here on the left-hand side of the screen here, what I try to underline in my clumsy drawing, using my clumsy drawing skills, is really profitability outlook for the 2020 crop. Now, lentils, with lentil prices being a lot better than what they've been in the past, with yields that are, somewhat positive, then you're looking at a gross margin, which would be the difference between the black line and the dark blue bar, something positive. But you have to be realistic as well about your land costs, right? So if you properly account for, if you own the land and you properly account for the opportunity cost of that land, then you need to add to your, to your gross margin by considering the relevant fixed costs, right? And so in some cases where you own the land, you're looking at some decent profitability. But if you are honest about where you stand when it comes to opportunity costs, it'd be a different story. Obviously, you'd have to add up the cash rent if you're renting the land. That still showing some profitability that is going to be tight just across the different spectrum of the various crops, right? So we have futures now that are pointing upward for a lot of different crops, which I think is partly driven by a very strong export demand, partly driven by some production challenges in the US. Bottom line is that they've been moving up, so we're not, right away being confident inserting these into our own calculations. We're waiting for markets to tell us a little bit more. Nevertheless, I think it's pointing in the right direction. If you're doing the same exercise for crops in central Canada, looking at corn and soybeans, this is what it looks like. Soybeans have been going up definitely, significantly in the last little while here, on some strong China purchases as well as weather concerns in the United States. I'm going to finish on farmland. One of the things that we were asked about quite a bit is, will COVID-19 change anything with regards to the farmland market? So this is the picture at the end of 2019. What we did early this week is we released what we call a mid-year assessment. So in that first column here, we're looking at a 3.7% increase in average farmland values in Canada for the first 6 months of the year. But what I find interesting is comparing the most recent 12 months, so it accounts for an entire cycle, right? So year to year, the pace of increase in the last 12 months, that would be July 2019 to June 2020. Compare that to the previous 12 months that we have, right? Which would be the entire calendar year 2019. And for the most part, right, if you compare the pace of increase, it's in most provinces, it would actually be slower. But there are two provinces for which that's not the case. And I say a slight acceleration in the growth of average land values. Well, yes, everything but in Saskatchewan and Alberta. And because these two provinces account for such a large share of farmland overall in Canada, well, that'd be the same thing for the national number at the very bottom of the table. Bottom line is there's strong demand for land, right? Why are we seeing the rate of increase that we're seeing, given everything that I was talking about in terms of pressures on liquidity and so forth? Well, a couple of reasons. Interest rates help. Low interest rates do help for sure. I don't, no doubt. Supply of land still limited. And, I'd be remiss if I didn't mention that, reporting is a 7.9% 12-month increase, or 4.2 if you focus just on in the case of Saskatchewan for the first 6 months. This does not mean that land values are increasing everywhere. We have to be cautious about that. Land values are flat in some parts of Saskatchewan, some parts of Alberta. in Manitoba. They are moving up elsewhere. I would say that usually the bottom half, in terms of quality of land, is moving up slightly faster than the top half. And so at the top half, we're seeing sort of a flattening out of those land values, where at the bottom half, we're seeing it move a little bit faster. So have to exercise cautious, but definitely, I think there's definitely a bit of momentum overall for land values if you just focus on the first 6 months. Another caveat to all of this is that we've yet to get all the information that we need to understand the COVID-19 pandemic and the influence of the pandemic on the land market. So far, not seeing any signs. Having said that, there'll be more transaction coming in between July and December, and then we're going to be reporting across the entire calendar year as well in April, which will give us a better picture, a better understanding of what the market is at. But overall, I think it's a pretty strong showing in the land market. Rebound is on the horizon. I don't doubt that for a second. I think the message is in terms of expectations, what this rebound is going to look like, maybe even into 2021. I would say that I would expect those last percentage points when it comes to unemployment, those last percentage points when it comes to GDP. I mean, I would expect those to be a lot harder to get than the ones that we're going through right now. So I think, one of the things to remember, but as we're, reopening the economy, more driving, more economic activity in general, or reopening food services, trade relations that in some cases are warming up, in others that need a little bit of attention. There's a lot to be confident about, but I would also say that there's a lot that we need to plan for in terms of risk management. So I believe that would be a good time to turn it over to you, Greg. I don't know if we have time for questions. I know I may have went all the way to the time that I was allotted, but anyway, if there's any question, I'd be happy to answer.
Oh, thank you, JP, for the presentation and for sharing your insights. And we do have a little bit of time for at least a couple of questions. If you'd like to ask JP a question, please use the Q&A function at the bottom of the screen. Why don't I get the ball rolling, though? India is top of mind for this industry. What is the outlook for India's economy this year, JP?
This is going to be a critical year for India. There was a super interesting study done by McKinsey that was looking at the labor market in India, because a lot of the growth in GDP needs to be happening to solve some of the pressures that we're seeing in the labor market in India. For example, the fact is India is one of the very few countries that are seeing their active working population grow, right? They're expected to add 60 million more workers in the next 10 years. There's an estimated 30 million workers that are in the farm sector right now that are expected to want to transition to the non-farm sector, as well as a potential 55 million women looking to get into the active labor market, right? So all in all, that's potential 140 million people looking to work, more people to work in India over the next 10 years. And that requires significant investment in India as infrastructure, education, and so forth to get to GDP to where it needs to grow to be able to absorb this increase in the entire population, active population, right? So a lot of different challenges for India. At the same time, I always wanted to point out that they're not immune to some of the challenges when it comes to the pandemic. So I think it's a critical year for India, right? There's been a lot of reset when it comes to India in terms of the ability and the place that it has in terms of leading economic growth worldwide, and sort of the little bit of the debate, India versus China type. But I think it's a critical year, and 2021 will be a critical year for India when it comes to economic growth. Lots of opportunities, but some serious challenges as well in getting it right for the people in India.
Good, thank you. We have one question here that I want to forward to you from the audience. JP, you mentioned that the Bank of Canada balance sheet growth as a percentage of GDP has been larger than the US Fed and other major central banks. What do you see as the medium-term or long-term impacts of this for Canada?
So the medium term is going to be more downward, not more downward pressure, but continued low interest rates across the entire yield curve. I do expect that to be the case. there was a real concern, significant concerns, I think, that were warranted as well. The fact about the ability of businesses to access the capital that they needed to continue functioning, right? And I think from that standpoint, from a short-term and medium-term outlook, I think the actions of the bank were actually led to providing some financial relief to businesses, and Canadian households as well. That was warranted and needed. Now, long term, like I said, we don't have the experience that the U.S. has in offsetting or unwinding those type of actions, right? So the U.S. was just getting started unwinding some of the actions that they took during the global financial crisis of 08 and 09. And from everything that we know, I mean, the unwinding didn't cause any type of disruption in the financial markets. I mean, but they were just getting started, right? They had a very little history of doing so. And then now the U.S. is shifting toward, I would say, a major shift. It went under the radar a little bit, this idea that the bank is shifting their target for interest rates and their entire monetary policy framework in the U.S. Canada is going through the same exercise right now, that is to look at the framework for setting monetary policy in Canada. So there are a lot of unknowns going forward, more of a long-term, question in terms of how all of this is going to be unwinded. But I would say we're not even at that stage of considering. First of all, we have to make sure that we get out of this economic crisis in a spot that we're confident we can grow again. Then second, we're going to be looking at revising or reviewing the Bank of Canada mandate and see what it means for Canadian businesses and households. And then after that, I would expect the bank to focus on sort of unwinding some of the actions that they've taken during the crisis.
Very good. Well, thank you once again, JP, for joining us. It's always good to have you join us at the Paulson Special Crop Convention. I want to again acknowledge and thank Farm Credit Canada for sponsoring the Global Outlook session. We're already 2 sessions in, but we're really just getting started. We're going to take a quick break now. We'll be back in 5 minutes with our first Market Outlook session of the day. Be sure to come back and join us for the Special Crop session.